Ever feel like you could save hours by just knowing the core insights of a really complex financial report?
Definitely.
Well, you've come to the right place. Today on the Deep Dive, we're laser focused on NXP Semiconductors' latest earnings. This is for Q1 2025.
Yep, we've waded through the reports, the news calls, all of that.
Exactly.
Yeah,
So
yeah.
you don't have to. Our mission really is just to give you the essential understanding. Where does NXP stand right now? How did they measure up? And, what are the key things moving forward?
Think of it as your shortcut to getting up to speed quickly. We've got quite a bit to cover, but we've broken it down into 5 chapters. Should keep it manageable.
That's the plan. First, we'll hit the executive snapshot for the big picture. Then Chapter 2 will really dig into the results versus expectations.
Then in Chapter 3, we'll look at the drivers and what management is highlighting.
After that, Chapter 4 is all about the outlook and those crucial key metrics. And finally, Chapter 5 will wrap it all up with our bottom line takeaways.
And look, if you find this kind of deep dive valuable, please do subscribe to the Stock Analytics AI YouTube channel. We do more of this analysis there.
Great point. Now, before we jump in, just the usual quick notes. Remember, this is all for informational purposes. It's definitely not financial advice.
Absolutely.
And also, just be aware that AI has helped us out with analyzing the source materials we're discussing today. Okay, let's get straight into it. Chapter 1, Executive Snapshot.
All right. So the headline for NXP's Q1, well, they did manage to modestly beat what analysts were expecting, both on revenue and their non-GAAP EPS.
Okay, so what were the numbers?
Revenue came in at $2.835 billion. That was just a fraction above the consensus, which was around $2.83 billion.
Barely scraping by the consensus then.
Pretty much. And their non-GAAP EPS, that was $2.64. Again, a bit better than the roughly $2.60 that analysts were looking for.
But, as always, that headline beat doesn't quite capture everything, does it? Because underneath that, the comparisons to previous periods tell a different story.
That's exactly right. While they beat the very recent estimate, the underlying growth, well, it wasn't growth. Revenue actually dropped 9.3% compared to Q1 last year. That's the year-over-year number.
Okay.
And it was also down 8.9% compared to just the previous quarter, Q4 2024. So sequentially down too.
And earnings followed suit.
Oh, yeah. Non-GAAP EPS saw really substantial drops, down 18.5% year-over-year and down 17.0% quarter-over-quarter.
Wow. So they clear the hurdle, but the overall trend is definitely downwards. How's management framing this?
They're using the phrase cautious optimism. They're acknowledging it's a challenging market, pointing to things like tariffs and just general uncertainty out there.
Sounds like they know it's tough, but want to project some confidence.
Exactly. And speaking of management, there's a pretty big piece of news there, too. The CEO, Kurt Sievers, is planning to retire.
Oh, okay. When's that happen?
It's slated for October 28th, 2025, so still a ways out. But they've already appointed Rafael Sotomayor as president, effective pretty much now, April 28th. It looks like a clear succession plan to ensure a smooth handover, especially during these tougher market conditions.
A CEO transition during a downturn. That adds another layer of complexity, doesn't it? Something investors will definitely watch.
For sure.
Now, despite those revenue pressures you mentioned, how did their core profitability hold up? Were margins okay?
Actually, yes. That was a relative bright spot. Their non-GAAP gross and operating margins showed quite a bit of resilience. Didn't drop nearly as much as revenue.
So they're managing costs effectively then?
It certainly seems that way. That's crucial when your top line is shrinking.
Makes sense.
Yeah.
And looking ahead to Q2, what's the guidance telling us? Any sign of stabilization?
Well, the midpoint of their revenue guidance for Q2 is $2.90 billion. So that is a slight tick up from the $2.835 billion in Q1. Suggests maybe things are bottoming out on the revenue side.
But what about margins? Are they expecting those to recover too?
Not really, based on the guidance. It suggests continued pressure on margins in Q2. So even if revenue inches up, don't expect a big profitability jump just yet.
Okay, got it. So let's try to summarize this snapshot for investors. Key takeaways seem to be they beat low expectations, but the underlying trend is definitely a cyclical downturn.
Right, especially hitting industrial and IoT and communication infrastructure hard.
While automotive, their biggest segment, seems more stable, relatively speaking.
Yep, and a big one. Significant inventory buildup, both their own and in the channel.
Okay. And despite lower cash flow, they're still focused on shareholder returns.
Aggressively so, yeah. And then there's that CEO transition happening over the next year and a half.
All right. That sets the stage nicely. Let's move on to Chapter 2, Results versus Expectations. digging a bit deeper now.
Okay, so as we said, that Q1 revenue, $2.835 billion, it did slightly beat the consensus of around $2.83 billion.
And it was also in line with their own guidance, right?
Yes, pretty much right at their midpoint. So they delivered what they predicted there.
And the earnings beat. Non-GAAP EPS, $2.64 versus the $2.59, $2.60 consensus. That's becoming a bit as a habit for them, isn't it?
It is. That's the third EPS beat in the last 4 quarters, so they seem to have a knack for managing expectations on the bottom line.
But we have to keep hammering this point. The underlying growth picture is negative.
Absolutely crucial. Let's just restate those numbers because they matter. Revenue down 9.3% year over year, down 8.9% quarter over quarter.
And the earnings drop was even steeper.
Much steeper. Non-GAAP EPS down 18.5% compared to Q1 last year and down 17.0% just from Q4.
So even though they cleared the analyst bar, the business itself contracted significantly. What does meeting their own guidance tell us in that context?
Well, it probably suggests they had a pretty realistic, maybe even slightly conservative view of the market when they set those Q1 targets. They anticipated the softness.
Suggests decent near-term forecasting, even with all the uncertainty.
I'd say so. It implies they're managing the controllable factors reasonably well, even if the external environment is tough. When you look at the detailed financials, yeah, you see the small beats on the top and bottom lines, but it's those big negative year-over-year and quarter-over-quarter percentage changes across all the key metrics: revenue, gross profit, operating income, net income, EPS, both ways you calculate it, GAAP and non-GAAP, that really paint the picture of the current challenge.
Right. Those percentages tell the real story behind the headline beat. Okay, that clarifies the results versus expectations picture. Let's move to Chapter 3. What are the drivers and management highlights?
So here we're trying to understand management's perspective. That phrase, cautious optimism, keeps coming up.
Right.
And they're quite open about the environment being, quote, very uncertain, influenced by tariffs, and just generally challenging market conditions. No sugarcoating there.
So given that challenging backdrop, what's their stated strategy? What are they focusing on?
It seems to be very much about controlling what they can control internally. Things like operational execution, keeping a tight lid on costs,
Makes sense.
and continuing to make strategic R&D investments. They specifically called out automotive and industrial and IoT as areas where they're still investing for the future, despite the current slowdown.
Okay. Were there any positive drivers they highlighted beyond just, hitting their numbers?
Honestly, not really. The main focus in their commentary was clearly on navigating the headwinds, managing the difficulties rather than pointing to strong positive momentum anywhere.
And the main negative drivers they called out?
It was primarily about the broader macro uncertainty and those tariff effects. They see these as contributing to the weakness pretty much across the board in their different segments. It's not isolated to just one area.
Okay. And we touched on the CEO change, but let's look at it again in this context. Kurt Seaver's retiring, Rafael Sotomayor stepping up. How does management frame this?
They frame it as a planned, orderly transition. They emphasize that 6-month overlap period between Sotomayor becoming president and Seaver's retiring to ensure continuity.
But doing it during a downturn must add pressure, right?
Oh, definitely. It adds an element of uncertainty. Investors and analysts will be watching very closely to see if Sotomayor signals any shifts in strategy or, a different approach to execution, especially given the tough market.
Yeah, that'll be key to watch. Now, strategically, they didn't just focus on costs, they also made an acquisition.
They did. They bought a company called Kinara Inc.
What's the story there?
It cost them $307 million. The goal is specifically to boost their capabilities in edge AI. So processing artificial intelligence directly on devices rather than in the cloud.
Okay, so that's clearly a forward-looking strategic bet on a growth area.
Exactly. It shows they're still investing for the longer term, even while managing the current cycle.
And what about returning cash to shareholders? We mentioned it briefly, but how significant was it given the earnings drop?
It was actually very significant. They returned $561 million in Q1 through buybacks and dividends.
Wow. How does that compare to the cash they actually generated?
That's the remarkable part. It was 131% of their free cash flow for the quarter, so they returned more cash than they generated.
131%. That's aggressive.
It really underscores their commitment to shareholder returns, but yeah, doing that while cash generation is lower definitely uses up financial flexibility.
A strong signal, but maybe one that raises questions too. Okay, let's move to Chapter 4. Outlook and key metrics. What are they telling us about Q2?
All right, the official guidance for Q2. Revenue is expected between $2.80 billion and $3.0 billion.
Okay, a $200 million range.
Yep. The midpoint there is $2.90 billion. Now, as we said, that's a slight sequential increase from Q1's $2.835 billion.
But how does it look year over year?
Still down. That $2.90 billion midpoint represents a 7.3% decline compared to Q2 of last year. So the annual comparison is still negative.
Got it. And profitability for Q2, what's the guidance there?
Non-GAAP gross margin, they're guiding between 55.8% and 56.8%. The midpoint is 56.3%. That's actually a tiny bit higher than the 56.1% in Q1.
Okay, slight improvement there. What about operating margin?
Non-GAAP operating margin is guided between 30.8% and 32.8%. Midpoint there is 31.8%. That's basically flat compared to the 31.9% they just reported for Q1.
And the bottom line, EPS.
Non-GAAP diluted EPS is expected between $2.46 and $2.86. The midpoint works out to about $2.66. Again, pretty much flat compared to the $2.64 in Q1.
Okay, let's compare that guidance to what analysts were expecting before the release. How does it stack up?
Well, that revenue midpoint of $2.90 billion is actually slightly above the pre-release consensus, which was, somewhere around $2.86 to $2.87 billion.
So a slight beat on the revenue guide versus expectations.
Yes. And the EPS midpoint of around $2.66 is pretty much right in line with where consensus was, maybe $2.63 to $2.67 billion or so.
Okay, so putting that together, the guidance suggests revenue might have hit its low point in Q1 with a small bump expected in Q2.
Seems that way, sequentially at least. But the year-over-year decline continues, which is important.
And the fact that margins are guided basically flat, despite that higher revenue, what does that suggest?
It probably points to ongoing pressures. Could be mix, could be pricing, but it might also be related to that inventory situation we keep mentioning. Trying to move older stock, perhaps?
Well, let's talk about that inventory, the key performance indicators, or KPIs. What are they showing?
This is where it gets quite concerning, frankly. Channel inventory, that's the stock held by their distributors, it jumped up to 9 weeks.
9 weeks. What was it before?
It was 8 weeks in Q4 and only 7 weeks back in Q1 of last year. So a steady climb. It signals that products aren't selling through to end customers as quickly.
Okay, so inventory's piling up in the channel. What about NXP's own inventory?
That's also increased significantly. Their days inventory outstanding, or DIO, basically how long stuff sits on their shelves, shot up to 169 days.
169 days. That sounds like a lot.
It is. Compare that to 151 days just last quarter and 144 days a year ago. It's a substantial buildup of unsold goods in their own warehouses.
Wow. Are other working capital metrics moving too? Like how quickly they get paid?
Yes. Their days sales outstanding, DSO, how long it takes customers to pay, also increased. It's up to 34 days now, from 30 last quarter and only 26 a year ago. So cash collection is slowing down.
Okay, so inventory up, receivables collection slowing. What about how quickly they pay their own bills?
That one, days payables outstanding, or DPO, was relatively stable, around 62 days.
But the net effect of rising inventory and slower collections must impact their overall cash cycle, right?
Massively. The cash conversion cycle, which combines all those, has lengthened significantly to 141 days.
141 days. What was it before?
It was 116 days just last quarter and 105 days a year ago. So that's a big jump. It means their working capital efficiency has decreased quite a bit.
So let's be clear. You have inventory rising significantly, both at NXP and in their distribution channel, happening at the same time.
Yeah.
That sounds like a major red flag.
It's definitely a key concern. It strongly suggests that production has been running ahead of actual end demand.
Which could mean trouble for future orders, couldn't it? And maybe even pricing pressure down the line.
Absolutely. If distributors are full and NXP itself is holding a lot of stock, it reduces the need for new orders and could force them to discount to move inventory. It's a classic inventory correction dynamic.
Anything else on the metrics front? Leverage?
Just briefly, their net financial leverage ticked up slightly to 1.6 times from 1.5 times last quarter and 1.3 times a year ago. That's likely related to funding that large capital return program while free cash flow was lower.
Okay, a lot to chew on there with the outlook and metrics. Let's try and pull it all together in our final chapter, Chapter 5. Bottom line takeaways.
All right. So summing it all up, NXP did manage to beat analyst estimates for Q1. That's the headline. But those results came alongside really significant year-over-year declines across the board. It clearly reflects the challenging semiconductor cycle they're operating in right now.
And we saw that weakness wasn't uniform, right? The automotive segment held up relatively better.
Definitely. Much better than industrial and IoT and communication infrastructure, which were notably weaker.
Okay, and a huge point we just discussed, that significant inventory buildup, both on their books and in the channel.
That's probably the biggest near-term concern to watch. It really could impact future quarters.
On the positive side, though, they did maintain those profitability margins reasonably well, despite the revenue drop. Shows some operational discipline.
True. Good cost control seems evident.
And they're sticking with that aggressive capital return policy, returning more than 100% of free cash flow via buybacks and dividends.
Yeah, even though free cash flow itself is down and leverage ticked up slightly. It's a commitment, but one with trade-offs.
Looking forward, the Q2 guidance suggests things might be stabilizing sequentially, maybe bottoming out.
But certainly not signaling a strong recovery yet. Year-over-year declines persist, and they expect continued pressure on margins.
So for anyone following NXP, what are the absolute key things to monitor in the coming quarters?
Number one is inventory levels. Both theirs and in the channel needs to come down. Number two, any signs of demand recovery, especially in those weaker industrial and communication segments.
Okay.
Third, keep watching automotive. It's their biggest business. Need it to stay resilient. And fourth, the CEO transition. How does that unfold? Any strategic shifts under new leadership?
Got it. So the big picture takeaway is NXP is navigating a tough cyclical downturn. They're trying to manage through it while keeping their eyes on long-term opportunities in auto, IoT, edge AI.
Exactly. But they're facing very real near-term headwinds from the market slowdown, that inventory overhang, and now this leadership change adding another variable.
It really is a balancing act for them right now, managing the present while investing for the future.
Precisely. Short-term pressures versus long-term potential. That's the crux of it for NXP today.
Well, that wraps up our deep dive into NXP Semiconductors Q1 2025 earnings. Thanks for joining us as we unpacked all of that.
Yeah, key things to remember. They beat estimates, but against a backdrop of significant declines. That inventory build is a major watch item. Outlook is cautious, suggesting stabilization perhaps, but no strong rebound yet. And of course, the leadership transition is now officially underway.
So here's a final thought to leave you with. How might that big inventory pile, combined with a new CEO coming in over the next year or so, actually influence NXP's strategy? Will it force certain decisions? How will it affect their ability to really capitalize when the market does eventually turn back up? Something to think about, that interplay between the short-term challenges and the long-term game in a cyclical industry like this.
And for more analysis like this one, don't forget to subscribe to the Stock Analytics AI YouTube channel.
Indeed, and just one last time, this discussion was for informational purposes only, not financial advice, and AI did assist in analyzing the source materials. Thanks for listening to The Deep Dive.